Here's a question that might change everything you think you know about money. Why do billionaires sometimes pay less in taxes than a teacher making $50,000 a year? The answer isn't about shady accountants or complicated tax rates. It's about understanding three fundamentally different approaches to money that separate the wealthy from everyone else. We're about to dive into the unconventional financial strategies the rich use to save, spend, and grow their wealth in ways that would shock most people. Let's start with a concept that sounds completely backwards. While most of us are taught to save money and avoid debt at all costs, the ultra-wealthy have mastered the art of strategic borrowing. They've found a completely legal method that allows them to access unlimited cash without ever paying taxes on it. We're talking about hundreds of millions of dollars flowing through their accounts while the tax authorities can do nothing but watch. Think about how you were taught money works. You earn an income, and you pay taxes. You invest what's left, it grows, and when you sell, you pay taxes again. You buy a house, you sell it later for a profit, and you pay more taxes. When you try to pass that money to your children, they face taxes too. It feels like the same dollar gets taxed over and over and over. For most people, this just seems like an unavoidable fact of life. But this is where the wealthy discovered something fundamental about how our tax system actually operates. Buried in the tax code is a simple, powerful distinction. Borrowed money is not taxed. A loan isn't considered income because it's a liability. It's something you owe back. This single distinction creates an enormous opportunity that most people never even consider. The strategy works like this. Instead of selling appreciating assets and triggering a massive tax bill, wealthy individuals use those assets as collateral for a loan. Picture this. You own a business worth $10 million, and it's growing at a healthy 12% a year. Instead of selling a piece of it and paying a fortune in capital gains taxes, you go to a bank and borrow $5 million against it at a 4% interest rate. That $5 million lands in your bank account, completely tax-free. And often, the interest payments on that loan can be structured to be tax-deductible. Now here's where it gets really interesting. While you're using that $5 million of tax-free cash to fund your lifestyle or make other investments, your original assets are still appreciating in the background. That $10 million business becomes worth $11.2 million the next year, but your loan balance is still just $5 million. Your net worth just jumped by over $1 million, and you haven't triggered a single dollar in tax obligations. This cycle can repeat year after year. As your assets grow in value, you can borrow larger and larger amounts. You can even use the loan money to acquire more appreciating assets, which you can then borrow against, creating a powerful compounding effect. But the final piece of this puzzle is what happens when the original borrower passes away. Their heirs inherit everything at what's called a stepped-up basis. This technical term represents a massive tax advantage because it resets the tax clock to zero. All the appreciation that occurred during the deceased person's lifetime, all those millions, or even billions in growth, gets wiped completely clean for tax purposes. This creates a system where debt becomes a powerful tool rather than a burden. For a select group of people, taxes become almost entirely optional. They can access the value of their enormous wealth without ever technically realizing income that would be subject to taxation. Now you might be thinking this sounds too good to be true, and the reality is, this approach isn't available to everyone, and it comes with very real risks. Banks require substantial equity before they'll lend against assets. They need stability, predictability, and assets that hold their value. A billionaire with a $5 billion business can borrow billions against it, but someone with $100,000 in stocks faces much stricter lending rules. And the debt itself is completely real. You're not eliminating obligations, you're just deferring them. Eventually, those loans have to be addressed, either through refinancing or when the estate is settled. Market risk is also a huge factor. This strategy only works if your assets are appreciating faster than your interest costs. If your business value drops 40% during a recession while you owe millions against it, you suddenly become dangerously over-leveraged. Interest rates matter enormously. If you're borrowing at 5% while your assets are only growing at 4%, you are actively losing wealth. The numbers have to work in your favor consistently. And then there's legislative risk. If this strategy becomes too widespread, Congress could close these loopholes overnight. We've seen it happen before when certain tax advantages get too much attention. But understanding this approach reveals something profound about how wealth actually functions at the highest levels. The wealthy aren't necessarily working harder or even earning more income in the way we think of it. They're playing an entirely different financial game, with different rules and different objectives. While someone earning $100,000 a year pays taxes on every single dollar, the wealthy structure their entire financial lives around asset ownership and leverage. They aren't focused on maximizing their taxable income. They're focused on building and accessing wealth through appreciating assets and strategic debt. This is why wealth psychology is so important. It's about understanding which financial game you're actually playing and whether the rules of that game are set up in your favor. Some people hear about these strategies and feel defeated. Others see it as a blueprint for building the kind of asset base that makes these techniques possible. The fundamental difference lies in shifting from employee thinking to owner thinking. Instead of focusing only on earning more income, the question becomes, how do I acquire valuable assets that appreciate over time? This could be starting a business, investing in real estate, or developing intellectual property that generates ongoing value. The traditional financial education most people receive teaches responsibility and tax compliance. It prepares you to be a good taxpayer, not a strategic wealth accumulator. 3 key takeaways emerge from this. First, significant wealth is built through owning assets and using leverage, not from a high income alone. Second, our tax system has always favored assets over earned income, but this advantage isn't widely taught. And third, building real wealth requires thinking like an asset owner, not an employee. The path forward isn't just about getting raises or cutting expenses. It's about systematically building assets that compound in value over time. The financial system most people learn about is an incomplete picture. It focuses on responsible money management, but rarely pulls back the curtain on the actual mechanisms that create generational wealth. Understanding these strategies isn't about agreeing with them or thinking they're fair, but recognizing how they work provides a crucial insight into the real rules of wealth building. Whether you eventually use similar approaches or simply understand why wealth inequality persists, this knowledge changes how you think about money forever. The wealthy have always played by a different set of rules. The question is, now that you know them, will you learn to think with this broader perspective in mind?